You are watching Market Pulse Daily. Today is Friday, May 22, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Oil prices could surge to about $200 as the Strait of Hormuz faces closure, sparking inflation fears and a potential Federal Reserve pivot. Today's agenda: geopolitical oil shock, Federal Reserve policy shift, AI's labor market impact, gold and silver's ascent, Bitcoin's role as a hedge, market update. The biggest story today is the escalating geopolitical crisis impacting global. The biggest story today is the escalating geopolitical crisis impacting global energy. The Strait of Hormuz, a critical global oil choke point, is facing a severe closure. This event is being called the most significant oil market disruption since World War II. Analysts warn that if the closure persists, oil prices could surge to about $150 to about $200 a barrel within a month. This isn't just about gas prices at the pump. A sustained oil shock means significant cost-push inflation across the entire economy, impacting everything from transportation to manufacturing. It forces consumers and businesses to drastically cut back, a process known as demand destruction, to balance the market. While current oil prices are consolidating, the market is underestimating the duration and severity of this supply shock. Temporary buffers like strategic petroleum reserve releases and existing inventory are finite, and the physical restart of Middle Eastern production will take many months, if not years. Keep a close eye on the status of the Strait of Hormuz and the levels of global oil inventories. Any further escalation or depletion of strategic reserves will be a key signal for price action. The market is currently mispricing the risk of a prolonged and severe oil supply shock, which will inevitably lead to sustained high energy costs and inflationary pressure. This oil shock comes as the Federal Reserve itself is undergoing a major leadership change. Jerome Powell has officially stepped down as Federal Reserve Chair after an 8-year tenure. The Senate has confirmed Kevin Warsh, a figure known for being more pro-crypto, as his replacement. Meanwhile, the European Central Bank is signaling a possible rate hike due to rising energy costs. A new Federal Reserve Chair, especially one with a different perspective on digital assets, could signal a shift in monetary policy. The pressure to combat energy-driven inflation, while also supporting a fragile economy, creates a difficult balancing act. Warsh's appointment could mean a more open approach to digital currencies and potentially a faster pivot to lower interest rates if inflation can be managed. The U.S. 10-year Treasury yield remains steady for now, but the market is keenly watching for any signals from the new Federal Reserve leadership. The potential for a policy pivot, especially if triggered by an energy shock, could lead to a significant influx of cash into the market, supporting stocks and other riskier investments. Pay close attention to statements from the new Federal Reserve Chair, Kevin Warsh, and any commentary from other central bankers. The upcoming CPI data and Federal Reserve minutes will also be crucial in determining the policy path. The Federal Reserve's leadership change, coupled with persistent inflation fears, creates a dynamic environment where a policy pivot towards lower rates is becoming a more plausible scenario. Beyond energy and monetary policy, a fundamental shift is reshaping the very nature of work. The U.S. labor market is undergoing a significant structural change, with the civilian labor force shrinking by over 1 million people. This trend is largely driven by artificial intelligence automating roles, particularly in middle management, compliance, and auditing, what are called measure roles. This isn't just about job losses. It's about a fundamental decoupling of productivity from employment. As AI takes over tasks, remaining workers become more productive, leading to higher corporate profits even with fewer employees. This creates deflationary pressure on wages and a potential supply-side shock, meaning more goods and services can be produced with fewer resources. While official unemployment rates might appear stable due to people leaving the workforce entirely, businesses are seeing record revenue growth alongside layoffs. This paradox is leading to expanding corporate margins, a key driver for the AI-driven rally in tech stocks, but it also raises questions about future consumer demand. We need to monitor the labor force participation rate closely. Any further decline could signal deeper economic contraction, even if headline unemployment figures look good. Also, watch for corporate earnings reports that highlight AI-driven efficiency gains. AI is fundamentally altering the labor market, leading to a structural decline in workforce participation while simultaneously boosting productivity and corporate profits. In this environment of uncertainty, investors are increasingly turning to investors are increasingly turning to traditional safe havens. The global monetary system is undergoing a significant structural shift, with Asia emerging as a dominant force. Hong Kong is launching a government-backed gold clearing system, aiming to rival London's long-standing position. Simultaneously, there's massive physical silver accumulation by industrial players, driven by inelastic demand for sectors like solar and AI. This shift signifies a move away from a fiat-dominated regime towards one where physical precious metals are the primary store of value. As trust in traditional currencies and bond markets erodes, capital naturally flows into hard assets. Silver, in particular, is poised for significant appreciation as its monetary and industrial demand cycles converge. While retail investors might be liquidating at psychological resistance levels, institutional and industrial buyers are actively stockpiling metal. This strategic accumulation, driven by future production needs, suggests a strong underlying demand that paper leverage on exchanges like COMEX cannot fully capture. Monitor the progress of Hong Kong's gold clearing system and any further announcements regarding Eastern Central Bank gold reserves. Also, keep an eye on industrial silver demand figures, especially from the solar and AI sectors. The world is transitioning towards a system where physical precious metals, particularly gold and silver, are regaining their status as the ultimate store of value and a crucial input for future production. And what about Bitcoin and the broader crypto market in all of this? The narrative of currency debasement strongly supports a bullish medium-term outlook for Bitcoin as a non-sovereign store of value. In times of credit contraction and loss of trust in fiat, capital often flows into hard assets like Bitcoin and gold. However, crypto also faces high correlation risk with broader risk assets, meaning it can experience sharp drawdowns during liquidity crunches. Bitcoin's appeal as digital gold is amplified by the current macro environment. It offers a hedge against inflation driven by energy shocks and potential currency devaluation. The institutionalization of Bitcoin as a reserve asset and collateral base is reinforcing its long-term valuation, even if tactical treasury selling occurs. The crypto market is currently experiencing some fear, with the fear and greed index in the fear territory. Bitcoin is defending key support levels around about $75,000, but a significant liquidation event has wiped out over about $563 million in long positions in the past 24 hours. The market is highly sensitive to ETF flows and regulatory developments like the Clarity ACT vote. Key catalysts to watch include the Clarity ACT vote in the U.S. Senate Banking Committee, which could provide regulatory clarity. Daily Bitcoin ETF flows will also be critical indicators of institutional sentiment. Watch for any pronouncements from the new Federal Reserve Chair regarding monetary policy, as this could significantly impact crypto's correlation with risk assets. Bitcoin presents a dual outlook: immediate downside risk tied to market liquidity and correlation, but a strong medium-term bullish case as a hedge against inflation and currency debasement, especially if the Federal Reserve pivots. Today's live market snapshot: metals, crypto, stocks, and bonds. Now for our daily financial market update. Here is where the key asset classes stand as of today. Gold is trading at about $4,520, slightly lower on the day, and is slightly lower over the past 5 sessions. Silver is at about $77, slightly higher today, and slightly lower over the past 5 sessions. In crypto, Bitcoin is at about $77,400, flat on the session, and flat over the past 5 sessions. Ethereum is at about $2,150, flat today. Other major crypto: Solana at about $87, slightly higher, BNB at about $657, higher, XRP at about $1.368, slightly higher. On equities, the S&P 500 at 7,445.7, slightly higher. The Nasdaq at 26,293.1, flat. The Dow at 50,285.7, slightly higher. Internationally, the DAX at 24,606.8, slightly lower. The Nikkei at 63,378.9, higher. The FTSE at 10,443.5, slightly higher. On the bond side, the 10-year U.S. Treasury yield is at 4.6%, slightly higher on the session, and the 30-year yield is at 5.1%, flat. Elevated yields continue to place pressure on risk assets and growth valuations. Rounding out the macro picture, WTI crude at about $98 per barrel, higher. The dollar index at 99.24, flat. Euro dollar at 1.162, flat. The picture is mixed across asset classes, with no dominant directional theme yet. Investors are watching macro catalysts closely before committing to a clear risk stance. The coming days will be dominated by developments in the Middle East and signals from the new Federal Reserve Chair. Investors should brace for increased volatility as these factors play out, with precious metals and Bitcoin offering potential hedges against inflation and currency debasement. Thank you for your attention, and we will see you again tomorrow.